Welcome. You're watching Spotlight San Diego. It's tax time, and the IRS is very active with audits and collections. And there are about 50 new tax laws that recently went into effect. It's pretty overwhelming, right? Well, here to break it all down for us is our expert, Gary Quackenbush, a financial solutions attorney. Welcome back to the show, Gary.
Hey, good to see you again. Thank you for having me.
Let me tell you, this stresses me out.
Yeah, it does everybody.
But every time I talk to you, you have this very calming effect because you know how to simplify things so we understand it.
Well,
so tell us what's going on.
Well, the thing that's very interesting is the IRS, as we know, the IRS is collecting a lot of money. You know, they collect about $13 trillion a year. So that's the collection agency for our federal government. They've got a lot of power. 168,000 employees work for the federal government, for the IRS. So they collect a lot of money. And as you can imagine, Congress wants money, they need more money, so they're trying to turn over all the stones, dig under the bushes and see where they can find more money. So they're looking for people that maybe they missed something on their tax return or they're doing a lot more audits. They hired in the last couple of years 5,000 new auditors to go after people to see whether they've maybe cheated here or there or cut corners here and there in their tax returns.
So that's going to increase the audits. What percentage you think?
Well, right now, it used to be that partnerships and little sole proprietors wouldn't get audited very much, and they're doubling those. They're planning on doing another 3,000 to 5,000 audits of small business. Usually, it'll probably go up maybe 10 or 20% of small business, which is a scary thing for me.
That's a big number, though.
It is a big number.
So they're going after the small people rather than the big, huge corporations?
Yes.
Because it's easier to get the money because they don't have the pockets to protect themselves.
That's true. And because what they're doing is the IRS actually keeps track of dollars per hour in audits. So if the auditor is working on an audit for 3 or 4 hours and then finds an extra $5,000, that's a big rate. So they actually track rates, auditing hours, dollars resulting, and a lot of times it's this self-employed person that kind of doesn't understand the taxes, that maybe pushes a little too hard here or takes too many miles. Those are the ones that are kind of getting hit hard. Penalties, interest, there's a lot of numbers out there. So the audits have increased because the IRS is really trying to bring in more money. And the other thing that's increased a lot this year, this is kind of the scary part, we deal with this quite a bit, is the IRS has to collect the money, so you have the collection side of it. Now there's this term that I mentioned to you called the tax gap. And if you're looking at the IRS when Congress does their budget, they look at the tax gap. And what that is, it's a fancy name for how much money should we have collected and how much is still outstanding. So it's like this number that they have calculated every year on this is how much money we aren't getting. So if everybody paid their taxes in full,
they're like, we want our money.
That's right. So if everybody had paid all their taxes due in full, they would be at this number, but they're here. So the gap is what they need to collect. So every year they figure out new ways to try to push harder. They hire more revenue officers to do collections. So they're trying to close this tax gap, which means they're trying to collect more money. And right now, more money is what the IRS needs.
It reminds me of, the end of the month when police officers have to get their quota,
yeah, right?
And so they're everywhere trying to get you for any citation they can.
That's right.
Yeah.
We obey that. We drive safely towards the end of the month. Yeah, and I think there's some of that. And part of it, too, is Obamacare. Now, originally, when it was, and I don't want to get into all the politics of Obamacare, but the whole idea was originally it wasn't going to be a tax. In fact, we were told specifically it is not a tax on the American people. And then there was a challenge that went all the way to the U.S. Supreme Court saying, this Obamacare is improper, it's illegal, it wasn't put into the Constitution. And our Supreme Court said, well, it's a tax, so it's okay. Congress has the ability to lay a tax, and that's what it is. Now, the interesting thing is, let's say you didn't properly have your insurance like you're supposed to, and so you get penalized, which is going to be $98 per member of your family that's not insured, and you only have 2 months to get insurance. So if you don't have insurance by March 1st, you're going to head a penalty. Or it can be 2%. This year, 1% of your income. Next year, 2% of your income is a penalty. Who collects the penalty? Well, it gets reported on your 1040 tax return. So new lines on tax returns coming up in 2014, it's a line where you report if you have insurance, health insurance. And if you don't, you have to calculate the penalty, and then the IRS collects it.
But I hear people talk, water cooler talk, all over.
Sure.
And what I'm hearing is that the penalty doesn't outweigh the cost of getting insured.
The first year, okay, so it's $98. Yeah. It's like $90 a person the first year. So if I have a family of 5 and I don't insure by March 1st, then my family of 5 is going to pay $600 penalty.
Yeah, but that could be a month of insurance.
Or 1% of my income. Insurance. Or 1% of my income, whatever's higher.
It'll be.
So if 1% of your income is higher than $600, that's what you would pay. So that's the thing. And then next year, 2015, the penalty doubles and it's 2% of your income. That's the penalty. So the penalties are way bigger than anybody realizes. And the IRS is going to collect them. So it's the same collection machine that's taking your taxes because you didn't, put it right on your 1040. That's part of the collection machine now.
And they're going to be sniffing under every rock because these 5,000 new agents, they need to prove their weight. They need to offset the cost of hiring them, their salaries, right?
Sure.
Yikes. So what can we do? I mean, what are the things, like, what are the biggest mistakes people do?
Well, that's really a good question. I think what people do is they when they're putting together their tax returns, they kind of go, oh, nobody will catch me. Because we have this thing, well, if they don't catch me, it must not be wrong. And I think what people ignore a lot is they ignore their mail. So you get a notice from the mail. In fact, I got a notice from my mom the other day. She sent it to me because anything she gets, she goes, oh my gosh, I don't understand it. So she sent me this notice and she said, are they going to put me in jail? And I go, Mom, no, I'm not going to put you in jail. There was a pension, like a $3,000 pension draw that she took to buy a car, and she didn't put that on her tax return. So there's extra tax. But her question is, am I going to go to jail? And so
everybody's afraid of the IRS.
I know. Well, because that's the way the system is set up. If you weren't afraid of them, you wouldn't care about cheating. But of course you're going to be afraid. That's the way the system is set up. So with my mom, I said, just open your mail and read it.
What about don't cheat because you have good character?
Well, I wish that were everybody's philosophy. I wish Taylor Baldwin philosophy went out through our whole nation.
I don't know.
No, it is. I think it's part of your character. If you're gonna, be honest in business and honest with people, then part of it is to properly report and pay your taxes.
But I think another flaw is that people just don't know. It's ignorance. You know what I mean? Like you just don't know. It's stressful. And you're depending on one person doing your taxes, or you're trying to research yourself. And maybe those are the things that they're trying to catch as well. Your mistakes, your boo-boos.
And I think so too. And I think the mistake people make is when you owe a tax is you should find somebody that knows what they're talking about. Yeah. Because a lot of times I can go in and they'll remove penalties because they realize it's kind of like first offense. I'm a first offender. So first offense, or there's some other issue, and the IRS a lot of times will reduce it. There's also, if you owe a lot of tax, like sometimes you mess up your taxes, you're not sure really what happened. Maybe you had a bad preparer, maybe somebody was trying to help you, prepare them wrong. And there are ways to resolve it once you owe. Like you can do offer and compromise a lot of times where the IRS will take a percentage.
They'll take your firstborn.
They'll take your, well, I've had people offer that. Will they please take my firstborn? They will. He didn't want his firstborn either, so. But they won't take your firstborn, and you don't go to jail for not paying taxes. So you can work out payment plans, sometimes offers, sometimes a bankruptcy will get rid of taxes. So a lot of things that can be done. So to answer your question about what's people's biggest mistake is they put their head in the sand. But you know what that means? That means your rear end is still up in the air and the lion is still charging at you. So if they wouldn't put their head in the sand, they'd read their mail because it always explains what the issue is, and you can deal with it early on. Because if you wait, 1 or 2 or 3 years down the road, now we're dealing with all this interest and penalties. So I think mostly open your mail. Don't be terrified of the IRS.
And get somebody who's knowledgeable, who's up on all the new laws. Thank you so much. We'll see you again soon.
All right.
Estate planning.
All right. Thanks, Taylor.